In this guide, I will outline precisely how I would reconstruct my day trading career if I were forced to start from scratch today. Before I developed a scalable process that now allows for single-day profits of $3,000 to $5,000. I spent years in my 20s wasting thousands of hours in confusion. I also lost thousands of dollars unnecessarily. Had I possessed the foundational knowledge I'm sharing in this video, my path would have been much shorter. I will break this down into several critical phases. Foundational basics. A simple way of looking at trading to start with the basics. Essential tools. The websites and tools you will need to follow along with this process. Trading psychology. The mental framework that will either make or break your trading. Trading mathematics. A simple way to understand trading math, which can be confusing in the beginning. Technical analysis. Crash course. A complete course on the most important things I know about technical analysis. Strategy building. How to build and test your own strategies. Real-life application, applying everything learned to a real-life scenario to show them working in real time. By the end of this video, you will have a clear-cut, simplified path to starting your trading career properly. Setting the foundation, how markets move. To start, we must understand how the market functions without getting lost in overly complex technical details. When looking at a price chart, we are essentially viewing a visual representation of mass human psychology. This means there are buyers and there are sellers. The market is a constant battle between buyers, demand, and sellers, supply and demand. If demand outweighs supply, the market is going to move up until supply starts to outweigh demand, causing the market to correct. Volatility. This back and forth movement produces volatility, which refers to drastic big moves in the market. Trading opportunities. These big moves open up trading opportunities for us later. Our job. As traders, our job is to find areas where we can enter at a certain price and have the price increase to another price. Profit calculation. Your profit is the number of units bought multiplied by the increase in price. Investing versus day trading. The difference between investing and day trading lies in your perspective of time and risk. Investing. Typically, you might hold a stock for a year to see 10%, 20%, or 30% gains. Risk. If you invest $100, your total risk is $100 if the market goes to zero. Time. You effectively have to wait an entire year to get these returns. Day trading. By zooming in to individual days of movement, we can find multiple opportunities in a single hour. Scaling. This allows a trader to take the same $100 risk and potentially make $600, $700, or $800 in a single day instead of a year. As the numbers get smaller on a zoomed-in daily view, the math and strategy become more complicated. It becomes more important to properly calculate your risk and know the likelihood of a move happening. The starter toolkit. To begin as a beginner, you realistically only need 3 major things. Trading view. This is where we do all of our charting and analysis. It is your home base. Trading platform. A way to actually place trades. For cryptocurrency, I use Blowfin or Bybit. For stocks, many traders use TopStep. Trade Journal, a tool to track your progress. Understanding charts and candlesticks. While line charts show price movement, day traders use candles because they are a better way of getting information. Green candles. These mean the price started lower and closed higher. Red candles. These mean the open happened higher and the close was lower. Body and wicks. The body shows the open and close prices, while the wicks show the highest and lowest points reached. You can view these candles across different chart frequencies or time frames, ranging from 15 seconds to 1 full week. A lower time frame candle, like a 5-minute candle, shows 5 minutes of movement, whereas a 1-day candle shows an entire day of movement in 1 bar. Trading psychology, the 3 mindset shifts. Psychology is the most important part that will either make or break your progress. You must retrain your mind around 3 major points. Losing is not inherently bad. As humans, we view losing as a sign of insufficiency, but this does not apply to trading. Being wrong is not bad. You actually need to flip the human behavior of needing to be right on its head. Making money does not always mean it was a good trade. Making money regardless of process is a misconception. Success is about repeatable behavior. The math of profitability. Trading is about understanding how much you make when you are right versus when you are wrong. Uniform risk. You must quantify your risk, such as risking a specific dollar amount, like $100 every time. Probabilities, you can lose 70% of the time, 7 losses, and win 30% of the time, 3 wins, and still be profitable if your wins are larger than your losses. Example, if you lose $100 7 times, minus $700, but win 3 times with high multiples, for example a total of plus 10.8 risk units, you end with a net profit. Position sizing. You must calculate the exact quantity to buy to ensure that if the price hits your stop loss, you only lose your intended risk amount. Technical analysis crash course. I focus on 5 or 6 major technical analysis elements to find key areas in the market. Trends. Identifying if the price is generally moving up, uptrend, or downtrend. Trend breaks. Critical moves happen when a price breaks below an uptrend line and retests it as a downtrend. Fibonacci retracement, a tool used to find levels where price is likely to respond, such as the 50% level or the 61.8% golden ratio. Fair value gaps, FVG. Imbalances created by big candles where the price often returns to before continuing its move. Building and testing your strategy. The progression for building a trading strategy is as follows. Concept. Gathering ideas and observing general tendencies in the market. Rule set. Creating specific rules based on those observations. Evaluation. Identifying the win percentage and average win/loss size to see if it is profitable. Backtesting. Using tools like bar replay on TradingView to see how the idea would work in real time. Simulated/real account, moving from testing to a simulated account and finally to a real account. Execution and scaling. When trading live, particularly in crypto, you use limit or market orders. Leverage. This allows you to start with a smaller amount of money while maintaining upside potential. Example. Controlling a large position, for example $6,800, might only require $680 if you use 10 times leverage. Risk control. Even with leverage, you must ensure your stop loss is set so you only lose your predetermined risk amount. The path to mastery. Success in trading isn't about beating the market. It's about not letting the market beat you. Discipline beats excitement. Stick to your plan because it is repeatable. Control your emotions. Calm minds make clear decisions. Focus on process. Review every trade because data reveals truth, not ego. Risk small. Long-term wealth is built through survival in the market. Success is about doing the right things every single day, even when no one is watching.